Peter Lynch is a legendary investor who grew the Fidelity's Magellan Fund from a size of $20 million to over $14 billion with an average annual return of almost 30% in his 13 years of managing Magellan. Today, I would like to go over some of his best tips that I think will help the average investor to invest in profitable companies. The first tip Peter Lynch gives us is to buy what you know. This tip may seem straightforward, but it's also very important. There is always a desire for every investor to find and invest in the next big thing. But as investors, we have to be careful in the companies that we invest in and make sure that the products and services offered by the company is legitimate. If we don't take our time to research the companies that we invest in, it can prove to be very risky. To give one example, in the 1980s, there was a company called ALFIN Fragrances, which was an importer and maker of perfumes. Then one day, the company announced that they had developed a revolutionary face cream called Glycel, which they claimed could slow the aging process and reverse skin damage. Sounds unbelievable, right? But investors fell for it at the time after there was news that Glycel contained an ingredient developed by Christian Barnard, the first surgeon to do a successful heart transplant. And the company did make some money selling this magical face cream at high-end department stores. And so the stock price tripled after Glycel was announced. That is, until the scientific community raised their questions. And when the FDA found out about the company's claims, it requested that the company provide proof of Glycel's true effects. But instead of providing proof of its effectiveness, Glycel was pulled off from the shelves, and the stock plummeted from a high of $40 to just $2, a drop of 95%. The second tip that Peter Lynch gives us is that in the stock market, the most important organ is the stomach, not the brain. Every day, the stock market is open for business all over the world. Just on the New York Stock Exchange, the average trading volume on NYSE ranges between 2 and 6 billion shares. And most people have a legitimate reason for selling or buying these shares. But there are also people that decide to sell or buy stocks based on which side of the bed they wake up on. Add to that the ever-evolving news outlets that is accessible to the majority of investors thanks to technology, and whenever there is news of a trade war or a new earnings report, the stocks of many companies will fluctuate significantly on a daily basis. Back in March, when people realized that the COVID pandemic is not just a problem in China, many company shares fell. Even shares of Amazon, which is benefiting from COVID as people have to rely on their delivery services, fell from around 2,100 to as low as 1,600. That's about a 23% drop in just 2 weeks. A lot of investors at the start of the pandemic sold everything blindly without understanding how COVID will affect their companies. And for those that sold their shares of Amazon back then because they listened to their stomach and not their brain, they would have missed out on a 30% gain compared to if you just held on to your shares. So, the lesson to take away here is only to sell your shares of a company if the company's fundamentals or if its future outlook changes, not because everyone else is doing so. The third tip we have is no matter what price you pay for a stock, when it goes to zero, you've lost 100% of your money. This is a lesson that may go against the popular investing philosophy of buying low and selling high. Peter Lynch's point here is that no matter how cheap you buy a stock for, if the stock never goes back up, you will never see the high that you want to sell at. So you never want to invest in a company just because its market value is going down. You want to make sure if a company's stock price is going down, that the other investors that are selling are being short-sighted or overreacting to market news. The fourth tip is that with smaller companies, you are better off to wait until they turn a profit before you invest. Peter Lynch is telling us here that if you like the business model of a small but growing company, you should wait until the company proves itself to be profitable before you invest. Many smaller companies that have a growing revenue stream have a hard and long time before they iron out their bottom line to make themselves a profitable company. And many times, these smaller companies never figure out how to make themselves profitable. A good example of a company that you would have profited from if you followed Peter Lynch's advice is Tesla. Since its IPO, Tesla remained unprofitable for many years, and that led to the stock price remaining pretty much flat. But once Tesla started refining its manufacturing processes and turned a profit, many investors started to invest in the company because Tesla proved that it can make money. The final tip that I will go over today is that if you don't study any companies, you have the same success buying stocks as you do in a poker game if you bet without looking at your cards. This is a tip that is essential but hard to follow in your everyday life. When we invest in companies, we want to invest for the long term. Yes, there are people that make a lot of money day trading every day, but for most of us, we don't have the time or luxury to sit in front of the computer to buy and sell shares all day. So, the way to invest for most people is going to be long-term investing. But in order to be successful in long-term investing, we need to have the right research and confidence in our investments to help us sleep well at night and have a peace of mind in where we put our money. And through this channel, I hope to be able to help you guys find and invest in good companies and avoid bad companies that are overhyped. So make sure you hit the subscribe button with the notification bell icon turned on, and I will see you guys in my next video.